Okay guys, welcome back. Today we are talking more in depth about ticker SPYI. This is yet another new ETF that has a covered call strategy seeking to deliver high levels of monthly income while maintaining the prospects for capital appreciation in the long term. The fund has been blowing up in popularity. It just passed $100 million in assets under management, and it's only a couple of months old. And some people, like this guy on Seeking Alpha, is claiming that SPYI is superior to JEPI in every single way. So we're going to discover what exactly is different between funds like SPYI and JEPI. We're going to do side-by-side performance comparison with this, the S&P 500, xyld, and see how the fund behaves. And I also want to toss in my current opinion on the fund and where I potentially see issues forming in the future. So let's get right into this. The investment objective is as following. It seeks high monthly income in a tax-efficient manner with the potential for upside appreciation in rising markets. So this bit on the high monthly income, the upside in appreciating markets, that's the holy grail. Every fund tries to do that. What's more unique here is the mention of the tax-efficient manner. To give you guys more specifics on this aspect, the fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. Personally, I'm not a tax expert, but if there is a call option that is more tax efficient and doesn't have any other hidden negative drawbacks, then yeah, I don't see why they shouldn't be using that. But aside from the tax aspect of these call options, they do something else kind of unique with the call option aspect of the fund. So they not only sell call options, which is how most ETFs generate that high level of monthly income, but they can also purchase index options. And this is their secret to participating in the upside of the market. Yeah, so to summarize, SPYI is based around the S&P 500 index. Those are the equities you are investing in. When they sell call options, they have the ability to cover up to 100% of the index with at-the-money call options. They don't have to do this. They could cover a smaller portion, but they have the ability to cover up to 100% of the equities. And in that scenario, they can still have the potential to have price appreciation in a rising market because they buy call options further out of the money. And the call options themselves are supposedly more tax efficient. So let's go ahead and evaluate the performance of SPYI. We have to compare it against the S&P 500. That's the index it's based off of. I'm also going to toss in xyld. This is a systematic fund that covers 100% of the S&P 500 with at-the-money call options. xylg is similar, but they cover half of the S&P 500 with call options. And of course, JEPI. So this is the side-by-side price action of these funds over the past year. And in a moment, we're going to switch to the total return, which includes reinvesting the dividend. But I think taking a look at the price by itself is valuable. So the blue line here is the S&P 500. And as you would expect, it is the most volatile. It goes up and down the most, being that it's pure equity fund. The next closest one has to be the green line. This is xylg, and they cover half the S&P 500 with at-the-money call options. That's when we get to this red and the orange line. The orange line is SPYI, and red is JEPI. And I gotta say, these two funds, these lines here, have similar amplitudes to them. And then the purple line is xyld, pretty much in last place. And if we switch the metric now from price to total return, we can see how this changes. Right, so immediately I would say the field becomes much more competitive. It still appears to me that the S&P 500 in blue and xylg in green are the most in sync, and they have the largest price movements. And JEPI, xyld, and this new fund SPYI are all very similar. But I did notice a pretty big difference in one aspect between SPYI and JEPI. And to help us see that, let's go ahead and get rid of xyld. Okay, so in this view, JEPI is purple, SPYI is orange, and the S&P is blue. To me, it's pretty clear that SPYI more closely follows the benchmark than JEPI does. So during November 2022, JEPI had this weird period where it did better than the S&P 500. But then ever since then, it's been essentially flat the fund, even during this recent bull market. And SPYI much more closely follows the benchmark, even during this rising market. And this is where I want to inject my current opinion on SPYI. Based off the data we have, which only goes back a couple of months, the performance, when you consider the double-digit dividend yield, is very compelling. I really do like how it closely tracks the benchmark while delivering double-digit income. However, my main concern here is the active management involved with the call strategy. They're buying calls, they're selling calls. There's not that many guidelines with the call strategy, and it can be easy to mess up. I mean, just look at funds like NUSI, they have a more active approach to their call strategy. And back in 2020, it worked pretty well, but ever since then, it really hasn't. And that's just the risk with active management. Yeah, right now they could be doing a fantastic job, but at any time that could change. Another question I have here is the dividend. So XYLD, as I discussed, sells at the money call options on 100% of the S&P 500, delivering the maximum possible income, and their yield right now is 11.5%. SPYI has a similar strategy of selling call options, but they also buy call options. That's how they participate in the upside of the market, which should decrease the dividend yield. But yet somehow the yield is more, or at least very similar to XYLD. So I'm a little bit confused there on how they managed to do this and the sustainability of this crazy high dividend yield. I gotta admit, I do like the idea behind this fund, and I'm going to be closely watching its developments with bated breath. I am skeptical of the active management and the implications that brings with it, but if they do manage to continue to closely follow one of my favorite funds, XYLG, while having a higher dividend yield, it will be very difficult to ignore this fund. So that's going to do it for this one. Hope you guys enjoyed, and I'll see you in the next one.